IPO is one of the most anticipated events in the financial market. It stands for Initial Public Offering, which means the first time a private company offers its shares to the public through a stock exchange. For companies, it's a significant step that transforms them from private to public. And for investors, it's an opportunity to buy shares of a promising new company at the earliest stage of its entry into the market. IPOs are often surrounded by excitement, hopes for significant growth, and of course risks. What is an IPO? An IPO is the process in which a private company offers its shares to the public for the first time through a stock exchange. Before an IPO, a company is owned by a limited number of people, including founders, early investors, venture capital funds, or employees. However, when a company decides to go public, it opens access to its shares to any interested investor. This is the moment when the company becomes public, and its shares begin trading on an exchange such as NASDAQ, or the New York Stock Exchange. Why do companies decide to go public? There are several reasons. One of the main reasons is to raise capital. By listing its shares on the exchange, the company attracts funds that can be used to expand the business, develop new products, or pay off debts. It's also a way to give early investors and company employees the opportunity to sell their shares and make a profit. Example: imagine a Silicon Valley startup developing a revolutionary new product, and the company has already raised millions of dollars from venture investors. But to scale production and enter international markets, it needs more capital. At this point, the company decides to conduct an IPO and attract funds from the public. The company's shares begin trading on the stock exchange, and any investor can buy them and become part of this growing business. How does the IPO process work? The IPO process is a complex and lengthy procedure involving several key stages. First, the company must choose underwriters, which are investment banks that will help organize the IPO and sell the shares. The underwriters assess the company's value, set the share price, and promote the IPO to potential investors. First, preparation. The company begins by preparing the necessary documents, including financial statements, business plans, and information about its operations. All this must be submitted to the Securities and Exchange Commission, SEC, which reviews the documents and grants the company permission to conduct the IPO. Second, marketing and roadshow. After filing the documents, the important phase of marketing the IPO begins. The underwriters organize a roadshow, during which the company's management meets with large investors, such as pension funds, institutional investors, and banks to present their company and generate interest in buying shares. Third, setting the price. At the final stage, the share price is determined. The price must attract as many investors as possible while providing the company with sufficient capital. Sometimes the price may exceed expectations due to high demand for shares, and other times it may be lower if the interest in the company is less than anticipated. Example: when Airbnb was preparing for its IPO, its shares were priced at around $30 each. However, due to enormous demand, the stock price soared to $150 on the first trading day. This indicates that investors believed in the company's future and were willing to pay more than initially expected. Advantages of an IPO for the company. For a company, an IPO is not only an opportunity to raise capital, but also a way to increase its visibility and credibility in the market. Public companies are under the scrutiny of investors, analysts, and the media, helping them strengthen their reputation and expand their customer base. First, raising capital. The main advantage of an IPO is the ability to raise significant funds for business development. This money can be used for expansion, acquiring other companies, or developing new products. Example: Uber raised billions of dollars through its IPO, allowing it to continue expanding into international markets and investing in new technologies such as autonomous vehicles. Second, increased liquidity. After an IPO, a company's shares become liquid, meaning they can be easily bought or sold on the stock exchange. This gives early investors, employees, and founders the opportunity to profit from their investments by selling their shares at market prices. Risks for investors. Despite all the advantages, IPOs carry significant risks for investors. This is because the company going public may still be young, without established financial stability, or even without profitability. Investors are buying shares based on promises of future growth, and if these expectations are not met, the stock price may fall. Example: let's remember Snap Inc., the creator of Snapchat. During the IPO, the company's shares were priced at around $17, and many investors expected the company to grow rapidly. However, after the IPO, the stock began to fall rapidly. and a year later it was trading at about $7. This shows that even the most popular companies may not meet investors' expectations. How to invest in an IPO? Both large institutional investors and individuals can invest in IPOs. However, access to IPOs for retail investors may be limited, as most of the shares at the placement stage are sold to institutional investors. This is because large investors can buy large volumes of shares immediately, and brokers prefer to work with them due to their reliability and capital. But if you want to participate in an IPO, there are several ways to do so. First, some brokers offer their clients access to IPOs. This may be an opportunity to buy shares at the offering price before they start trading on the exchange. Second, you can buy shares after they are listed on the exchange, but it's important to understand that the price may fluctuate significantly on the first trading day. Example: when Facebook conducted its IPO, shares were priced at about $38 each. However, on the first trading day, the stock price fell, and some investors incurred losses. Later, the stock began to rise, but this case showed that IPO investments can be unpredictable. How to evaluate the success of an IPO? The success of an IPO is measured by several indicators. First, the amount of capital raised. If a company can raise more funds than it planned, it indicates high investor interest. Second, the price movement of the shares after the IPO. If the stock price increases, it means that investors believe in the company's future. However, it's important to remember that short-term success doesn't always indicate long-term stability. Example: Zoom, a company that became popular due to its video conferencing services, held one of the most successful IPOs. After listing, the company's stock price increased by 200% within a few months, making Zoom one of the most valuable tech companies. This was a successful IPO, but it's important to watch how the company continues to develop. Conclusion: an IPO is an exciting event in the market that can bring both big profits and significant risks. For a company, it's an opportunity to raise capital and go public. For investors, it's a chance to get in early on a promising business. However, success is not always guaranteed, and it's important to carefully analyze the company before investing in its IPO.